Hi everyone, my name is Barun Chandra and in this video we'll talk about balance sheet, the second most important financial statement that companies submit to the exchanges. In the previous video, we talked about profit and loss statement or income statement. So in this video, we will continue with the balance sheet. We will look at some of the characteristics of the balance sheet and how they help us to identify any company that we are looking to invest. So let's make a start. So what is balance sheet? So balance sheet is basically a snapshot in time. It represents the financial situation of a company on one particular day, the moment it was written. So as I said that every quarter on certain day, the companies write financial statements, which includes balance sheet as well. So the statement that is published to the exchanges are the reflection of the financial situation of a company the day it was written for the quarter results, right? So it shows you what an overview of what a company owns today. Basically, those are assets. How much company owes today in terms of its liabilities, and how much a company is worth today, which means assets minus liabilities is equal to your shareholders' equity. There is another definition to it, which has been published by Thomas Itelson, the author of Financial Statements. So what he describes is that what you own minus what you owe is what you are worth. So exactly, this is another way of stating what a balance sheet is. Next, we will look at the another kind of definition for the balance sheet, which is how we split it up. So again, in simple terms, what a company owns is described by assets. What a company owes is described by liabilities, and what a company is worth is described by equity. So in total, because balance sheet has to balance, right? It's a scale, right? So in balance sheet, assets should always be equal to liabilities plus shareholders' equity. So in other words, we can say that the assets have been financed partly by liabilities, by taking a debt from financial institutions, from banks and so on, and partly by shareholders' equity when the company goes public. So assets are funded by two ways. Sometimes company directly go to the banks to take debts, and sometimes company raises equity for their own assets building purpose. Now that's what the definition of assets and balance sheet is. Next we'll take a look at some of the company sample financial statements, balance sheet, and we'll take a look at what those characteristics are. We'll take a look at the balance sheet of Alphabet, which I have access through acc.gov website, which is the US exchange for the company registered there. And this report is called 10K because this is an annual report submitted by the companies in Q4. All prior reports, quarterly reports are called 10Q, but in the fourth quarter, the report itself is called 10K because that becomes equivalent to your annual report. So if we look at the balance sheet structure of Alphabet, we have three sections here as per our definition. We have assets at the top, we have liabilities in the middle, and somewhere at the bottom we have shareholders equity. So as we say, the definition of balance sheet is that assets must be balanced by shareholders equity and liabilities. So within assets we have current assets. Current means in less than 1 year, and then we have long-term assets. Similarly, we have liabilities where we have current liabilities and long-term liabilities. So starting with current assets, we have the item sorted in order which can be converted into cash first. So example, the cash itself, right? So that becomes at the top. And then we have short-term investment, which is market securities. So that becomes your second item. Next, we have account receivables. So account receivables means the money that is owed to us by the customer, So since we have sold our services and product to the customer, instead of customer paying us instantly, what we basically tell them that don't worry about it, you can pay me back in 27 or 28 days from now. So that becomes our cash deficit and that gets recorded as account receivables in the asset section. And definitely then we have inventory. So inventory is again something that comes under current asset, which means that can be realized into cash in less than 1 year. So in that we have three different type of inventory. One is called raw materials. Next one is called work in progress. And the third one is called finished goods. So all in all, I mean, they all constitute inventory itself. So that consists of all our current assets that company has. And if we look at right side, definitely in 2020, Alphabet has more assets compared to 2019. Next comes liabilities. So in the liabilities, again, we have current liabilities, which can be repaid in less than 1 year. Then we have long-term liabilities like long-term debts, which comes under uh, long-term liabilities. So in that we have the first item in the current liabilities is called account payables. It means the company owes certain money to other people, right? Vendors and so on for the services that company has bought. And then we have accrued compensation and other expenses that constitute rest of the current liabilities. Then, as I already talked, then we have long-term debts, which comes under long-term liabilities. So all these consist of your current. So your current and long-term liabilities becomes your total liabilities. And as we can see, the Alphabet liabilities has significantly gone up in 2020 compared to 2019. Then we have uh, then we have shareholders equity. So in the shareholders equity, we can see that the companies has issued uh, some shares in 2020 compared to 2019. So the total number of shareholders equity have gone up in 2020. Now, as per our definition, as I said, that assets have to balance total liabilities and shareholders equity. So as we can definitely see, this is where our total assets is, this is where our total liabilities is, and this is where our total shareholders equity is, and it is definitely balancing. I hope this video is useful to you.